We're going to take our time today in this webinar to dive into what we can see happening now, what we might expect happening for the rest of the year. We are in a time right now that is really difficult to communicate about the market. We have a lot of expectations from the beginning of the year. We have a lot of headlines and a lot of data points that, especially the ones that are lagging, that are still very bearish, very negative on the housing market. We have consumer expectations of a lousy economy, and yet the data is actually showing us surprising resilience this spring. We have surprising number of buyers, surprisingly tight inventory. And so we're in a moment where consumers are afraid, and yet maybe they shouldn't be, or at least they should see the data so that they can make better decisions. I had a phone call this week from a hard money lender, and she has worked with these investors in previous deals, and they're working on fix and flips in Denver. And she said, Mike, I'm afraid to lend to them. They're good people, they do good work, but I mean, isn't the market tanking right now? And so I said, let's look at Denver. And it turns out that her fears of rising inventory and weak demand were all based on last fall. And so we looked at the data for that zip code in Denver, the price point that her investors were looking to buy, and the price point that they were looking to remodel and sell at. And we could see remarkable resilience in those price points. And so, we don't know, while we don't know about, does a recession hit hard in the future? And we know that last fall, Denver was one of the markets that slowed most dramatically, one of the big boom markets during the pandemic, and slowed very quickly when things slowed last year. But at this moment, we were able to look and see dramatically different data than what this hard money lender had expected. And it allowed her to make a different decision or have a very different conversation with the investors that wanted to borrow the money. It was really fascinating. And I have a suspicion that so many participants, both buyers and sellers in this market, don't realize what's happening right now. So we're going to try to share what's happening right now. And in fact, over the years, I've said my favorite moments when running Altos research have been those moments when I can be contrarian and bullish at the same time. Meaning the headlines are very negative. The headlines are still reporting year over year home price declines. And those declines happened last fall. And so every month for several more months, we're going to hear home prices are down, home prices are down, home prices are down. And in fact, they are lower than they were last year at this time. So those aren't wrong headlines. But at the same time, the data shows in the moment, there's recovery, there's demand, especially for the current really tight levels of supply. And so in a lot of these markets, home prices are recovering from what they did last year, from that dramatic slowdown last year. And as a result, there's a little bit to be bullish about in this market when the headlines are bearish. And so being contrarian, when everybody knows the market's hot and everybody's buying, that's easy. When the headlines are very different from what the data says, that's the time that the data is most fun. Like, people are afraid and you get to show them reasons to not be afraid. So that's what we're going to talk about in the data today. We're going to see, will we ever have any supply this spring? We have, as always, as we do these webinars, we have a lot of people from all over the country attending. In the chat, we have the chat open. Look for Jeff Graves and Lael Black from the Altos team. They will be sharing links and trying to answer questions as I go along. Use that chat. We're going to go through all the inventory data and the forecast for the rest of the year. Before we dive into the data, I have a couple of fun announcements that we get to make now. Then we'll talk about price trends. There are some risks in the economy. There are home buyers now, inventory is tight, demand is sufficiently high, but demand could fall off if the economy tanks hard, and inventory could finally build in an environment where people start losing their jobs. Those kinds of risks are real, and we'll talk about them. So what we're trying to do is use the data right now, what we can see right now, and also then should buyers and sellers know about the data? They can have fears about the economy, but don't let those fears misguide you on what's happening right now. And then, of course, we'll take the second half of the conversation to dive into the local markets. I've got some interesting local markets. I'll show you that Denver zip code where those buyers are with that hard money lender was working with her investors to go work on on those properties. And we'll look at some of the other markets around the country. So first announcement, we're hiring at Altos. Last fall, December, Altos Research was acquired by HW Media, the publishers of Housing Wire. And one of the things we get to do is expand our team. We have building out our sales team, and we call the role business strategist. If you know Jeff on our team, you've met one of our on the business strategist team. And I like to share this with the folks who are on this webinar because the people who know the Altos product best are also the people that can help others get that, can join us. So there is a link to the job posting on LinkedIn in the chat. If you're interested, or somebody who would be great at working with the technology and the data and helping real estate and mortgage and title professionals use the product, that's what we're hiring for. So I'd love to have you on the team. If you apply for the job, and let them know that you saw it you were on the webinar, because that's very meaningful to me. So we'll hopefully be adding to the team very soon. And there's a link in the chat right now. The other thing we have right now, a nice offer for today, is for new customers. If you've been on the fence or looking at Altos data and you've been delaying to join us as an actual customer, we have decided to do a free month with a promo code. You go to sign up for Altos today. You can use the promo code TaxDay23 because it's tax day and we could all use a break. So for new customers who sign up today, in fact, this will be available through tax day Monday, which is I think the 18th. You can go sign up and get your free month of Altos. And so we don't do promos very often. So if you've been on the fence and thinking about it, new customers will get a free month if you sign up using this promo code today. There's a link in the chat too. So 2 announcements that we get to do before we dive into the data. Would love to have you join us. Let's start looking at the mortgage rates. Mortgage rates have been ticking down, especially since the bank failures of a few weeks ago. We're finding ourselves settle in this 6% range. We have, and on this chart, the colors are a year, so that each year, so this is more than a decade worth of data here. And the bright red on the far right side of the chart, that's this year. You can see when as rates are inching closer towards 6%, one of the things that we've noticed is like you can see the pickup in buyer activity. When it's over 7, you can see it cool significantly. We can observe a couple things happening. When rates are close to 6, many buyers are choosing to buy down the rate and now getting it under to 5 or under, like 4.5. And all of a sudden, those payments are significantly more affordable, especially if you're planning on being in a place for a long time. The other thing that's happening is if I'm qualifying for a rate at 6.2 or 6.3%, and I expect rates to fall in the future, I can just plan to refinance, and then my home only gets more affordable as soon as that moment comes. And I think a lot of buyers right now have that strategy. And what we can see is that, there are a remarkable number of buyers, and as rates jumped last year, the market cooled, and especially in the second jump of the year, they jumped from 5% to over 7.5. And that was at late in the year, and it really cooled down the market. Inventory built well into October and November last year, and as a result of this big spike. And so at that moment, though, what was interesting is, we expected inventory to keep climbing once we hit January and February, but rates dipped back down, and the spring buying season reset expectations. Their new strategies came out, and people are still well employed. So we still have really high levels of employment. And so as a result, we find price resiliency, we find demand, we're doing things like multiple offers, all of those characteristics of a warming housing market. I don't forecast mortgage rates, so I don't have any ability to tell where they're going to be at the end of the year. We do know that inflation is coming down pretty quickly, and lower inflation implies lower mortgage rates. We can see yesterday, last 2 days, we had below expectations of inflation, and those are always encouraging. And so we'll see later in the year. A lot of the forecasters are expecting that rates will be lower at the end of the year, and that will continue to encourage buyers. If they spike from here, maybe inflation is persistent and mortgage rates spike from here, then we can see the impact that we might have on inventory. That 5.5% felt like a real threshold to us. Maybe it's 6%. You could see because people were doing the buy downs, and but over 7 is when things were really slow. So here's what inventory looks like right now. There are 410, almost 411,000 single-family homes on the market. That is basically unchanged from last week. It just ticked up a tiny fraction from the week before. And there are a couple of things to see. I've presented the inventory data in this chart where each line here is a year. And you can see the curves from pre-pandemic were way higher, twice as many homes on the market in 2019 as now. Twice as many. More than twice as many. And normally this time of year, the reason I'm showing this year-over-year chart here is because you can see how quickly each week inventory is normally climbing. The dark blue line, the green line, even last year, the light red line at the very bottom, inventory was climbing rapidly each week by the middle of April. And this year, that's not been the case. And so when we started the year, we expected inventory to be climbing starting in January because you expected more sellers and a cold set of buyers, but that's like defied expectations pretty much every week all year to date. So when does that change? Probably next week. We'll probably in the next Monday's data, we'll probably see an uptick in inventory, a slight uptick. Certainly by end of April into May, we should see that uptick. The yellow line, that's 2020 when like everything was nuts, the beginning of the pandemic. And so then what does it look like for the rest of the year? This is the forecast line for the rest of the year. The dotted line is what we can forecast with the model for the rest of the year. The model currently assumes that we will have slowing economy and therefore inventory build like we had last year. Now, what's interesting is so far to date, the model has been overstating inventory expectations every week through since the start of the year. And so it could, right now, the model, it projects 575,000 single family homes at the end of the year, based on the fact that we're at 410 now. It could be, that number could be as low as 500,000 by the end of the year and not build it all this year. And that would be following assuming things like, okay, so economy slows, but that doesn't, people react by not selling their homes as opposed to selling their homes. Or we see economy slow, but job losses are later to happen. And so people still keep buying this year. Or rates tick down rather than tick up like they were last year. And therefore that makes it more affordable and we get more transactions. And so you could see there's a lot of scenarios where inventory ends the year closer to 500,000 than to 600,000. And, that would be a dramatic change from expectations, looking at last year's data. Last year's that light red line there, where it spiked, climbed April, May, June, July, really dramatically. And then again in October and November when rates jumped. And so that curve got us a little bit. And for a while, it looked like maybe we would get back to the old normal, but there's no signal anywhere in the data of any surge of inventory imminent. So where could inventory come from? Inventory could come from normal buyers and sellers, like I'm moving and I'm selling, and we have, like, I'm going to go buy a new home, and so I sell my first home. We have, obviously, that's what the life events and those types of things are what's happening right now. Those are the buyers and sellers that are happening right now. Many of those buyers, though, because they have a mortgage rate on their first place at 2.8%, are choosing not to sell that one. And so we're literally just buying more properties. We're taking more off of the active market. Where else might inventory come from? Inventory might come from investors, where investors are saying at more expensive money, my investments, the deal doesn't pay off as well. I need to unload some of these. As of right now, I was talking with Gary Beasley, who is the CEO of Roofstock. He'll be on the Altos podcast next week, the Top of Mind podcast. Look for that one. Gary pointed out that none of the institutional investors, the big money, none of them are selling. And he knows all of them. That they've slowed their buying way down, but nobody is selling at that level. So we don't have inventory coming from the investor class yet. It could, but none has come yet. Or it could come from smaller investors, or it could come from individuals in a distressed standpoint where, like, I lose my job, I can't make that mortgage payment, and now I need to sell a house. As of right now, Americans are very well employed, so we have none of these natural sellers hitting the market. We expected some of them to happen. None of them have happened. And it's really important. And there's no signal in the data yet that any of them are coming. Now, when the economy changes dramatically, do those change? We'll look for the signals. We look for those signals every week. But for your buyers and sellers who have an expectation about the economy, they've read headlines about home prices are down, they probably assume that there's some flood of new homes coming, or that sellers are desperate, or they have some kind of very bearish assumption about the economy. And the fact is that there's no signal anywhere in the data of any of those supply opportunities starting yet. It's a really fascinating point. And we look for it every week. That's broadly true across the country. You know, there were some of the markets like Phoenix, for example, whose inventory grew last year, but you'll see, and we'll look, I think I have Phoenix up in the local market. We'll see Phoenix inventory isn't dramatically high. So there's a lot of those to keep our eye on. The thing to notice is this is like where are the sellers coming from. So this chart is our new listings volume each week. And each bar here are the total number of new listings that hit the market. The taller the bar, more new listings. This is a couple of years of data. So, and then the light part of the bar are the immediate sales. So these are the ones that get listed on Thursday and they take an offer on Saturday and they're in contract over the weekend. They don't even make it a few days. And what was remarkable, what we can see here is last year at this time, there were 90,000 new listings in that second week of April. A third of those were in contract immediately. And so you can see how big the light part of the bar was last year. This year, there's only 73,000 new listings this week, single family homes. But 25% of those are already in contract. And if you've got listings right now or buyers, you'll know about, there's the best homes are going quickly with multiple offers, even if they are, as someone put it, low ball bidding wars, where there's not dramatically overbidding happening, but there are multiple bids happening on those properties and they're going quickly. So you can see the stretch after July 4th last year, this dramatic drop of new listings that July 4th usually happens at, but people just stopped. So sellers pulled forward into the first half of last year and then really dramatically stopped. We can also see how the immediate sales also shrunk each week all the way down through the beginning of the year, through New Year's. And then they've started to grow again. Now it's the spring season, right? This is when people are buying homes, and this is when you would expect the peak numbers of immediate sales. So we can see here is supply and demand in the same chart. The total height there is we can see restricted supply, and we can see moderate levels of demand, and that's what participants in this market are feeling, and it is probably the opposite of what casual observers probably expect. They are expecting more inventory and no buyers at all. And simply not what the data is showing right now. So we should expect more new listings, hopefully, and I can see them around my neighborhood popping up. So in the next few weeks, we see this line grow, and that will hopefully lead to, more transactions and better activity, more selection for buyers. For buyers right now, because the immediate sales are, is smaller, that therefore there's slightly less competition. The big institutional money and the iBuyers and those types of folks have really backed off their buying this year. And so if I'm like a first-time home buyer, I have less competition than I've had in many years. And so that's a reason that some of those folks are participating right now, even if the payments are higher. Here's what prices look like. The median home price in the US right now for single family homes, if you walk out and look at the market today, is $439,900. The newly listed ones, $405,000. So the new listings are coming. The little activity is a little bit lower than what the median price is across the country. That dark red line, you can see it ticking up each week. Prices are rising each week. They are rising less steeply than last year. And you can see how quickly prices were jumping up last year. As a result, we are going to peak the year lower than last year's peak and down a little bit, and then end the year flat to down just a little bit. So we can really see, and we've been talking about this for, I don't know, 8 or 10 months about how 2023 looks to be flat or slightly down year over year in home prices. There isn't any sign anywhere in the data of collapsing home prices or even really falling home prices. They fell last year. This is that at the right end of the chart there, the down stretch from June, July through January this year, like they fell pretty quickly, much more quickly than most years. And so like that was, you could see home prices adjusting in the second half of last year. That is not happening this year. And it is, but the year over year comparisons are going to be lower. And the price of the new listings, the light colored line, is lower than last year at this time. So let me show you that one in a little more detail. This is taking the price of the new listing. So each week, the homes that get listed for sale, where do they get priced? And I like this one as a leading indicator of where sales will be in the future, because what happens is the sellers and listing agents, they know how many bidders were at the last house down the street. They know if there's overbidding or underbidding, and they know if there's no bidding at all. And so when it comes time to list the next house, we know in aggregate to price it a little more strongly, or price it a little, give it a little discount so that we know that we're going to get the offers. So we can use the price of the new listings as a leading indicator of where the sales are going to happen in the future. And what we see is the new listings are now at $405,000, and you can see the dark red line is below last year at this time. So trading at a slight discount home prices to last year at this time. You could see how the light red line faded, it compressed way down in the second half of last year. And you can see that it was still rising April, May, June. And so over the next few weeks, we'll see the price of the new listings be lower, not significantly, but more low. We're down we're like 1.5% lower than last year, down to 2 or 3 or 4% lower, home prices lower than last year. And you can see it in there, and this is the leading indicator. And because these are homes that get listed now, maybe they take an offer in May and they close in June or July, those are priced lower than last year. So the headlines are going to report negative year over year home price appreciation. If these are closing in July, you're going to hear those headlines in August and September. So for the rest of the year, most of the rest of the year, your market participants are going to have headlines: home prices are down, home prices are down, home prices are down. We can already see it, even though that like you could see where the compression happened was all last year. So right now, the home prices are ticking up. They're ticking up more slowly than last year. And then later in the year, you can imagine that if economy holds up and the market, the current trends continue, we could see how we end up closer to flat rather than down. But those headlines won't get here until a year from now. So this is what you should expect to be doing, working with buyers and sellers this whole summer. They're going to be hearing home prices are down. And the trick is going to be communicating that, yes, they fell. Right now, there's actually a fair number of buyers. If you want to buy this house, like we need to make an offer now, and if we want to sell this house, we want to list it at the right price. And so those are going to be our challenges for communication in the coming year. There's another way to look at prices, and that's in pendings. So these are the homes in contract. And of the 300 and some thousand homes that are in contract right now, the median price of those, the final list price was $375,000. And that's also 1.3% lower than last year. You can see the light red line, it was still ticking up. It's the peak season. It always peaks in June. And you can expect that the dark red line will tick up a little bit, but it's going to continue to be lower than the pendings from last year. And these are in contract. So these are the ones that are the closest proxy to the sales that haven't happened yet. Houses in contract in April to close later in April or in May or in June, 36, 45, 60 days, when those close. And so we can already see that the homes that are going to be closing in May are going to be closing at a price lower than they were last May. We can see that, and we can see that because prices were still climbing pretty quickly last year, that's going to be bigger than 1.3%, probably 2, 4% at the peak. And then it'll be interesting to see how the end of the year, how quickly prices taper off this year. Did they taper off less quickly than last year? That's what we're going to be dealing with for the year. So again, these are the headlines for the future. You can already see what they're going to be. Meanwhile, though, the active market is giving us very different signals that is significantly more optimistic than what we will be reading in the headlines. The pendings count. So this is how many sales are happening. Each line here is the total number of homes in contract at that week. The light part of these bars is the newly pending homes in a given week. And there's a few things we can see here. So 346,000 single family homes in contract right now. That's 21% fewer than last year. At the beginning of the year, it was 30% fewer. So late last year is when it cooled way off, and having 30% fewer sales happening. Now there's 21%. We're closing the gap from last year each week, and we know that it's going to continue to close because the new pendings each week are 10% fewer. So it used to be 30%. Now it's 20%, and the future ones are 10% fewer. So we can see a little bit of that activity. It is not deteriorating from here. It's, thank goodness, a little more action happening than late last year. It's not a lot. We're in a supply constrained market, right? So if there were more homes for sale, there would be more transactions. It's not a demand constrained market. It's a supply constrained market. So, it'll be hard to have a lot more transactions because there's just not that many homes for sale. It's also why, if you pay attention to the mortgage application rates, you can watch the change, and we can watch it tick up or tick down. And it's actually been ticking up, the mortgage application rates. The total volume of mortgage application rates is lower than in a long time. But that's because there are fewer homes for sale. So you can't judge the total number of mortgage application rates, can't tell you about demand because we have a supply constrained market. But you can watch the weekly change in those application rates to see as another indication of demand ticking up. Okay. Let's go to price reductions, and then we'll switch over to look at some local stuff. So we have on the pricing side, the leading indicators of pricing. One of my favorite metrics is the percentage of homes on the market with price reductions. This week, we are down to under 30% with price reductions, 29.9%, tick down this week. So as demand ticks up, price reductions tick down. Each line here is a year, and you can see the light red line from last year was starting to pretty quickly climb. We could see that quick climb, right? You could feel that everywhere in the market, and we talked about it as it was happening. As you can see, demand is slowing down, has stopped cold in some places, and you got to start cutting prices. As a seller right now, what's happening? In general, we're in a moment of the year when you'd expect price reductions to start ticking up. If a house is listed in January, February, and doesn't have an offer yet, you start doing price reductions March, April. Normally, price reductions are kicking up in the second quarter, but they aren't yet. And that's because we have surprising levels of demand for the current really tight level of supply. So what's interesting here is, yes, we have more price reductions than we've had in recent years. The market's cooler. They're like it cooled way down last year, and it's been a fairly hot market for 5-6 years. And it was insane in the last 3 years. So the interesting thing on this chart is how steeply the slope is of that dark red line from 40% at the beginning of the year to now under 30. That was surprising. And it's still surprising each week. And if that supply demand dynamic keeps up, we could be under 2019 in a couple of weeks. And wouldn't that be a surprise? Like significantly back close to normal. But in the next few weeks, price reductions will start ticking up. That's what happens in the second quarter as we get closer to the June 30th peak. And then they peak, price reduction peak in later in the year, because they're like, if it's still on the market before school starts, let's try to cut again. If it's on the market before the holidays, we cut again. And so you get this annual curve in price cuts. The fact is, there's fewer price cuts than we expected. It's still ticking down in a time when it's normally ticking up. These are indications of surprising levels of demand, and it's worth mentioning. And again, it's like your buyers and sellers probably don't realize this. Let me switch real quick to here. Share this screen here to our looking at our price reductions for the big metros across the country. We can see that, and I've been showing, if you've come to these webinars in previous months, I like to show this each month. Last fall, the top list, the most price reductions were dominated by the Western US markets, Boise, Phoenix, Austin. And now, though, like Denver, some of those markets have recovered more quickly. And so the Florida markets are the top of price reductions right now. So here's Sarasota, and you can see this is a 3-year curve here. We are at the time, so Sarasota's price reduction started ticking up. Phoenix price reduction started ticking up. And now this is second quarter. It happens in that. But we can see that Phoenix is probably, is at a multi-year high, and probably we'll see. It'd be interesting to see if it gets back to last year's 60%. I don't think it's going to get that high there, but it's still most price reductions in the US right now is in Phoenix. But we can also see that, here's Central Florida, here's Daytona. So the Florida markets are really dominating the price reductions because the Western US markets have gone significantly, they recovered significantly more quickly than I expected, for sure. The exceptions on those, are Phoenix and Austin, which are still, which were probably the boomiest of during the boom, and very dependent on California migration, for example. So those are really an interesting change that we've seen over the last few months. And starting to tick up. So we can expect nationally that price reductions are going to start to tick up probably next week, in the next couple of weeks, to see that there. But I'm still surprised by that every week. So we keep our eye on it. Let's do a few more data points here, and then we'll do some more local stuff. So days on market. Days on market's much more close to normal time, about 2 months now. Last year was under 1 month for most of that spring buying season. There was, just all of the long-term stuff had gone. And so we are we're significantly closer to a normal cycle. And you can see the previous year, still a little bit lower than normal. Rents have been ticking up in the last few weeks. So Single family homes rents, it's up about 5% from last year at this time. And, but lower, there was a big spike in mid-year last year. So climbing a little bit right now. And I think that is likely in the same phenomenon of we have everybody employed. So there's household formation happening, driving the same amount of demand, same type of demand as home purchase demand right now. By the way, you know, I talk about this data. I sometimes talk about it really quickly. There's a lot of questions in the chat. Jeff and Lael try to answer the questions on the fly. If you haven't yet downloaded the Altos ebook, it's a free ebook. It talks about how to use market data in your business. It's like scripts and ideas, and it goes through all the data that I've been talking about today so that you can use that in your business. It's free. There's a link in the chat that you can go grab it. And by the way, you can go grab that chart, but that book, but also remember that there is the promo code that's tax day 23 for new customers. Get a free month if you're signing up today while you're watching the video. So go grab that ebook if you don't have it already. It's really great for that. Okay, let's do one more switch to some of the local markets. Here's Denver. So at the beginning of the webinar, I started talking, I mentioned I had a call from a hard money lender who was asking me. She said, I have investor clients who are in Denver, fix and flip. I've worked with them before. I like them, but Mike, I'm afraid of the housing market tanking. I'm afraid that it's tanking right now. And so she said, I just wanted to call and ask you what you know. And so we looked at this part of Denver, 80209, I think it was the zip code. And so, you know, first thing we did was said, okay, let's look at inventory. Inventory in that part of Denver here's pandemic lows. So we're off the pandemic lows, but still significantly fewer homes on the market than pre-pandemic. So inventory is still relatively tight. They were buying under $1 million. And so if we look at the price range quartiles, under $1 million, they're buying a 3.2. It had a unfinished basement that they were going to add a bedroom and a bathroom to. So they go to a 3.4 or 4.4 or 4.3. And so this is going from $1 million range to a $2 million range. It's the same lot size. And what's interesting is the days on market's actually faster at that price point. And so while my friend, the hard money lender, she was worried about Denver, I said, let's look at what we have right now. And we just opened it up and we looked at it and she goes, wow, that is incredibly different than I was expecting. And this lender, she lives in Salt Lake City and was lending in Denver. And it was dramatically different than what she had expected based on the headlines. And that's the power of using the data right now. We don't know. What's not in the data is what happens if there's a massive recession or big job losses. That's not visible. Like nobody knows. What's in the data right now is like, if these people can buy at a nice discount for a home that's an old home in this part of Denver and do a good remodel, finish the basement, like that looks like a pretty good opportunity to me to sell it in 14 days. So it was dramatically different. And it was one of the things that we like to do to help communicate about the market. And if you're working with buyers and sellers right now, they probably have that same impression. So that's really what we're trying to communicate. I have Truckee, California open because Truckee is one of the Zoom towns, the big remote work towns. And we talked about it over the years. You know, if you lived in San Francisco during the pandemic and, you know, people bought in Truckee and you could see Truckee's Lake Tahoe. What I was curious about is like, what's happening? Well, the market has come way down in Truckee. The average market time, was 20 days, 30 days way back when, and climbed dramatically last year. And so you can see a significant change in the market. Now, these are, some of these big, expensive, brand new homes are now taking 4 months to sell. A lot of these. So you can see a significant slowdown in Truckee, especially as Truckee is a tech focused Zoom town. So the folks who were, in San Francisco, and it boomed super dramatically out. And we can look at the market action index over time. And the market action index is the supply versus demand. And normally it's in this slight seller's market. Here it boomed up during the pandemic. And then last year it came way back down and is actually ticking lower right now, and is probably going to tick into the buyer's opportunity markets. It's a really dramatic change for some of those Zoom towns. So I mentioned Phoenix earlier. We talk about Phoenix a lot. Phoenix is a bellwether for the housing market in the US. A lot of investor activity, a lot of growth. Here's what to know about Phoenix. Phoenix inventory climbed dramatically last year. Phoenix inventory has been dropping much more quickly than expected since the first of the year. And right now the dots on this chart are years. So here's middle of April, just in the pandemic. And then 2019, 18,000 homes on the market in 2019 and 8,000 now. So even though Phoenix slowed really dramatically, you can see that the market action index is ticking up. It still says strong seller's market. Some people in Phoenix might say, hey, it's not strong. Ultimately, what the math is doing here is saying, normally there's 20,000 homes on the market in Phoenix, and man, there's only 8. Like that's what the math is pointing out in that case. Even if it doesn't necessarily feel like a strong seller's market, it is restricted inventory, and it's something that buyers and sellers should know. And it's ticking up. So you can see each month this spring that market action index has been ticking up. We're going to look at Phoenix or at Philadelphia here. So my brother is moving from the DC area to Philadelphia. They're going to take care of their in-laws. That's one of those big life events. They also, though, have a 2.5% mortgage on their home in Falls Church that's on the metro, and they're never selling that thing. And so they're moving and they're buying and not selling, and therefore inventory stays restricted. Here's what to know about Philadelphia. We have the inventory here. Philadelphia, and much of the Midwest and Northeast of the US, is still at basically crisis lows, pandemic lows of available homes to buy. If you're a buyer in Philadelphia, in the metro region, you'll know that significantly fewer homes than even a few years ago. 20,000 homes, 20,000 homes, and there's just over 5,000 right now. And my brother was at an open house. He's shopping, he's looking at the house, and he said, I had to leave because the line to get into one of the bedrooms was too big. I couldn't even see the house. And like that was the buyer competition that he's facing a week ago. It's again, like I said, very different from what you'd expect given home prices are falling headlines. When we look at the price segments in Philadelphia, we can see that, the low end stuff, the old stuff, small, takes longer to sell, but we can see exactly where the demand is in that $400,000 or $500,000 range. We can see exactly the fastest time on market right there. And that's important for people to know. Yes, that homes are on the market longer, but in your price range, you're in the highest demand segments of the market. Let's look, it's getting long here. So let's look at LA and then we will wrap up. Inventory in LA. So LA was very sensitive last year as the market slowed. And you could see inventory climb. And then here is after the first of the year, inventory has been falling each week as we've had more buyers than sellers. We can see like Phoenix LA market action index is ticking up. And again, you may not feel like this doesn't feel like a strong market, but there is literally a third of the number of homes on the market in LA than there normally is. It's like, it's so restricted that that's what the math is responding to there. We can also see exactly where the demand price points are here. The super expensive stuff in LA takes a lot longer. But in general, those are what we know. And let's look at price reductions in LA just for kicks. So where you can use price reductions as a leading indicator for future transaction prices. So we can see where sales are going to happen in the future. And we could see last year that price reductions went from record few, only 10%. This, as people were cutting their prices, and then mortgage rates jumped late in the year, price reductions spiked again. So these price reductions in November are deals that get an offer in maybe December or January. They close in February. And we're hearing those headlines now. Prices are down year over year. And you could see it happening a full year ago. What we see now is the opposite side of that. So not dramatically, not record few, but normal levels for LA. And so this tells us, and this is true across the country, there's no signals in the data for lower prices in the future. There's no downward pressure on prices. There's no, sellers are not feeling the pressure to cut prices because buyers are buying at these prices. So what that tells us is that even though, like I've said, the headlines are going to be home prices are down year over year, they're not actually falling, and there's no current signal in the data that they continue to fall. Now, if economy changes, maybe we get that we get a new shift of home price changes at that point. But as of right now, there's nothing in the data that would indicate that. Okay. I hope you join us. Go to altosresearch.com. You can book time with our team. You get that free ebook. Or if you are buying today, use the promo code TAXDAY23. It's all uppercase, TAXDAY23. And you'll get a free month. And we don't do a lot of promos. We don't do a lot of discounts, but it feels like it's tax day and everybody needs a boost on tax day. So we thought we'd try it. We thought we'd make the offer to new customers right now. This will be, if you're watching this video recording, this will be through tax day Monday this year. And that promo code will also be in the email that we send to everybody at the after this afternoon with the recording for the webinar. All right, everybody. Thank you so much for joining me today. I hope it was helpful. Stay tuned to the YouTube channel for next week's video, and we'll see you next month in the webinar. Thanks, everybody.